My name is Daryl Thomas. I'm the host of our VRIC Media YouTube channel, and so I work very closely with Jay. And many of you may recognize me from some of the interviews that I've done with some of our guests and speakers that are here at the conference today. So before we get started, I want to give a shout out to our VRIC team. They worked tirelessly to put this event together, and we're here today because of that effort. So shout out to them, and then thank you to you all for being here today. So show of hands, who here owns metals but no mining stocks? Show of hands. Anyone owns any precious metals but no mining stocks? Okay, we got a few. All right, who here is actively deploying capital in mining stocks? We got quite a few. Okay. So, regardless of where you're at on that spectrum, you know, the majority of us in this room already understand, at least intuitively, that something's wrong with our monetary system. And maybe you can't articulate it perfectly. Maybe you don't know all the data points off the top of your head, but you feel it. We live in a distorted economy. And so, when we look at phony inflation numbers, we see M2 money supply has continuously gone up and inflated away the purchasing power of the dollar. We have massive debt and deficits. So I'm a US citizen, so I always go to the national debt clock. I'm always checking that out. And this was just a screenshot at the time I got the screenshot, right? I know it's a lot higher than this now. So we got massive debt and deficits, and markets like the S&P at 500 and NASDAQ are making all-time highs, so people feel good. They feel that their pockets are growing, that their wealth is growing. But when you measure that in gold, it hasn't made new highs since the 2000s, okay? So the S&P hasn't made new highs since the 2000s, and it's rolling over in gold terms. So when you measure that against a real asset, you see that your portfolio isn't actually growing in gold terms. It's going up in dollar terms. So a lot of people believe that their wealth is growing right now, but really the unit that they're measuring it in is declining. So we hear this all the time, that gold and silver isn't going up, it's the dollar falling against it, and I want to treat that as foundational truth. And hands down, gold and silver are exceptional at preserving purchasing power. They have done so for thousands of years. There's no counterparty risk, there's no balance sheet, no management team you got to worry about. Right? They don't need permission and they don't lie. Unless you get something like this, okay? Anybody here ever got bamboozled and bought like a fake gold ounce or anything? All right, there's an old adage, if the price is too good to be true, it likely is, okay? So make sure you're buying from a reputable dealer, okay? But on a serious note, gold and silver does not multiply themselves. And that creates an uncomfortable question that I've been wrestling with. If my metals are simply offsetting currency decay, am I actually building wealth, or am I just standing still in real terms? So when the dollar erodes, its purchasing power erodes, it shows up everywhere. Retirement portfolios buy fewer goods, wages struggle to keep up with future costs and real costs, and that brings us to a real tension today of preservation or multiplication. So let me ask you, who do you think performs better over a full cycle? Who thinks the stacker performs better? Anybody in here in the stacker crowd? Okay, we got some stackers in here. Don't be unashamed of it. Yep, represent. All right, and then who thinks the mining investor performs better over a full cycle? Okay, got a show of hands. Cool. Well, to be honest, the case for the stacker is very strong. You're not risking capital, you're preserving it. There's no leverage, there's no guessing who the good operators are. And in a world that's built on debt and promises, that simplicity carries weight. But the case for the mining investor is very different. You accept that risk, and that risk cuts both ways. You could blow everything on a junior explorer that never gets permitted. You can get diluted into oblivion. You could hold forever, never realize a gain. You could pick the wrong jurisdiction, get a mine nationalized, the wrong management team, the wrong point in the cycle, or you can get lucky. Or better yet, you could be disciplined, selective, patient, and significantly outperform the physical metal. So that brings us to an important question. How should the capital be handled once it's preserved? And since gold and silver has been money for thousands of years, I'd like to point to some ancient teachings that highlight this dynamic of preservation versus multiplication. But before we go any further, I want to set some ground rules. This is not a religious message. I'm not here to interpret theology or make spiritual claims. We're just going to simply look at a parable the same way we would look at an old business case for the practical wisdom that's embedded in it. And I'm asking you to follow along with the logic of the story, okay? All right. Jesus tells this parable. Again, the kingdom of heaven can be illustrated by the story of a man going on a long trip. He called together his servants and entrusted them with his money. He gave 5 bags of silver to one, 2 bags of silver to another, and 1 bag of silver to the last. Dividing it in proportion to their abilities, he then left on his trip. A couple of things here. Jesus uses the word master and servant. That's old language. We're going to use chief investment officer and financial advisors on this one, okay? And the word bag is actually the Greek word talenton, which is where we get the word talent today. But in the ancient world, the word talent meant a unit of weight. And so a talent weighed between 75 and 100 pounds, depending on the region and the time period. And the word silver here is argyrion, which means silver money. So let's say it was 100 pounds of silver. That's roughly 1,458 ounces per bag. So the first financial advisor received 5 bags. That was about 7,290 ounces of silver. At $100 per ounce, that's roughly $729,000. Second advisor, 2,916 ounces of silver, 292,000. And then the third had about 146,000 worth of silver. So this wasn't no chump change, it was real capital, okay? So the advisor who received 5 bags of silver began to invest the money and earned 5 more. The advisor with 2 bags of silver also went to work and earned 2 more. But the advisor who received the 1 bag dug a hole in the ground and hid the boss's money. After a long time, the boss returned from his trip and called him to give account of how they had used his money. The advisor whom he had trusted 5 bags came forward with 5 more and said, "Boss, you gave me 5 bags of silver to invest. I've earned 5 more." The boss was full of praise. "Well done, my good and faithful servant. You've been faithful in handling this small amount, so now I'll give you many more responsibilities. Let's celebrate together." He pretty much says the same thing with the second advisor. So then you have the third advisor with 1 bag. He came and said, "Boss, I knew you were a harsh man, harvesting crops you didn't plant and gathering crops you didn't cultivate. I was afraid I would lose your money, so I hid it in the earth." He stacked it. He put it in the safe. "Look, here's your money back." But the boss replied, "You wicked and lazy servant or employee. If you knew I harvested crops I didn't plant or gathered crops I didn't cultivate, why didn't you deposit my money in the bank? At least you could have gotten some interest on it." So then he ordered to take the money from this advisor to give it to the one with 10 bags of silver. To those who use well what they are given, even more would be given, and they will have an abundance. But to those who do nothing, even what little they have will be taken away. All right, so a few things from this passage. One could speculate that Jesus was a silver stock speculator, okay? Jesus was in there trading the silver stocks. You know, he's a silver bug. But on a serious note, this was real capital, and the instruction was clear. He gave 5 bags of silver to one, 2 to another, and 1 to the last, and he divided in proportion to their abilities. So they were essentially hired to do a job, to invest the money, and they were competent enough to do it. So the first advisor with 5 bags of silver, let's say the boss entrusted him because he was into the alpha of the sector. So he was into the junior exploration companies. He's like, "Hey, I trust you with more money because you know your stuff." These are the Lobo T. Grays, the Jeff Clarks, the Rick Rules in the building, okay? Advisor 2, the boss may have said, "Yeah, go ahead and we trust you, but park this into the Newmonts and the Barracks, go to the Tier 1 miners, you stay over there." Advisor 1, "Okay, park this into the royalty streaming companies and the ETFs, buy the GDX, buy the GDXJ. You're new to the team, okay? We don't trust you with that much capital yet, but go ahead and park this in some safe bets." All right, so 2 advisors took action. They multiplied the silver. And the last did not speculate. He did not take risk at all, for he said, "I was afraid I would lose your money, so I hid it in the earth." He did not lose the money. He preserved it. And here's where the story becomes uncomfortable. The failure was not loss. The failure was inactivity. Preservation avoided loss, but it did not fulfill the mandate, and it did not multiply the silver ounces. So now let's bring this back to the markets. Okay, so coming out of the 2008 financial crisis, silver fell from roughly $21 an ounce to $9 an ounce. And then in 2011, silver peaked at a little under $50 an ounce. That was about a 400% gain over 2.5 years. And this is where the dispersion shows up, because several mining companies didn't just match silver, they materially outperformed silver. So at 70 cents per share, when the market crashed, First Majestic rose to over $25 per share. That was roughly a 3,500% increase. And then you had Coeur d'Alene Mining, who increased roughly 850% from the lows, Hecla Mining 900% from the lows, and even Wheaton Precious Metals, which was then known as Silver Wheaton, they rose from $3 to $4 per share to about $40, over $40 a share. That's about a 10-fold increase. So the company significantly outperformed the metal, right? So let's even dig a little deeper into the math. So this isn't normal here, right? This is just if you were to time the tops and the bottoms with these companies, okay? That's a miracle if you're able to do that, all right? No pun intended. So if you had put $10,000 into physical silver at the 2008 lows, you would have ended up with about 1,111 ounces, and that would have totaled out to be about $53,000 measured in dollars. So if you would have put that into Hecla Mining, let's say you caught the bottom of Hecla, miraculously caught the bottom, okay? You would have actually purchased 10,752 shares, and that investment value would have increased to $123,000 before taxes and fees. And then if you converted that into silver at $48 per ounce, you would have came out with 2,574 ounces. You would have multiplied the silver ounces. Same thing with First Majestic. First Majestic, if you would have put $10,000 into at 70 cents and it rose significantly, that investment value would have increased to $385,000. Okay? And you converted that into silver at the top at $48 per ounce, you'd have ended up with 8,000 ounces of silver. Okay? So let's look at some real examples. These are just the charts. I had to keep changing these charts. Like you can see the percentage gains on silver versus Hecla, AG, First Majestic versus silver. So let's look at a real example. Okay, so a realistic example. So let's say you put $10,000 into Hecla and you caught Hecla at $2.50. You'd have purchased 4,000 shares. You sold it at $10. You didn't wait till it got to the height. You sold it at $10. You would have had a $40,000 investment return, but you would have converted it into silver when silver was lower at $9 an ounce. You would have ended up with 1,379 ounces, which would have been more than if you just parked it into silver at that point. Same thing with AG. So I had to keep running this math through, keep working through this math here, because I wanted to see, does the mining stocks perform better than physical silver? And not every mining stock will perform better than physical silver. But we're going to look at Liberation Day lows now, okay? If you'd have put $10,000 into physical silver at Liberation Day lows, you'd have bought silver at about $27.48 an ounce. That would have been about 364 ounces of silver. If you convert that to $100 an ounce, that would have been about $36,000, okay? Let's say you caught Hecla at $4.45. You'd have purchased 2,000 shares. That would have ended up being $59,000 in US dollars. And you converted that at $100 ounce silver, you would have 596 ounces of silver. So I can keep beating a dead horse, but I did the math multiple different ways, and I see that if you invest in quality companies, you're going to significantly outperform the silver metal, and you can buy more ounces of silver regardless of the price that silver is at that time, okay? So there's a massive opportunity here, and I just want to highlight VRIC here because VRIC actually said trading alpha for beta is important. So whenever you're up so significantly, you can sell those shares and then put that into physical metal. You can put that into some of the top quality companies, Wheaton Precious Metals or Agnico Eagles and such. You can trade that alpha for the beta. And so that's a strategy that I think is very effective. And so when I interviewed Rick last September, he shared that he was selling 25% of his portfolio, and he recovered his entire initial investment. He could even pay for the taxes, and he pretty much had zero downside risk from that trade. But he traded that for physical gold as well as Wheaton precious metals and Franco-Nevada. So he traded that alpha for beta. So that's a massive opportunity that we have with the stocks here. And it's important because you can use your excess returns to increase your core position. So if you are a silver stacker, you can increase your silver through the mining stocks, all right? And there's a lot of opportunity here today. There's a lot of mining companies here, so you got to do your due diligence, right? And I'm not going to say that every mining company is going to beat silver. But if you do your due diligence and you find solid companies, you will outperform the metal and you can buy more silver, so you can multiply your silver. So that's the end of my talk today. Thank you all for tuning in.